Hi, welcome to Let's Talk Bonds, the bond market podcast from INR Bonds. I'm Arjun Patsati, and lots of things happening in the markets, especially in the bond markets. Lots to talk about in this podcast. And coming towards the end of the financial year, a lot of turmoil as well across markets, and regulators and policymakers are scrambling all over the place to make sure the markets are smooth, trading smoothly. There's enough stability in the markets and having to fight a lot of external forces as well. So the bond markets are clearly pulling and pushing at all across all levels to regain some kind of stability. And in this podcast, I'm going to talk about all the factors that are affecting the bond markets and the impact on bonds for investors. Before that, please do follow INR Bonds Let's Talk Bond podcast on all podcast channels. And also, investors should be aware that bond markets carry interest rate risk, which is price risk, liquidity risk, and credit risk, which is the bonds could default. Now, let's get back to the podcast. Like I said, a lot of issues in the markets. First is liquidity. Now, liquidity, as in there's a lot of money going out of the system. The banks are very strapped for liquidity. The system itself is strapped for liquidity. A lot of this is contributed by the fact that the RBI has been selling US dollars to prevent the currency from a free fall due to a lot of global tensions happening. And this has taken liquidity that is liquidity available with the banking system to very deep negative levels. At one point of time in February, and it had touched close to 300,000 crores or 3 trillion rupees, which in deficit. Now, so clearly the lack of liquidity has been telling on many other aspects as well. And the RBI has definitely stepped in to address this liquidity issue. And one of the key factors, like I said, driving liquidity negative, which is stressed, was RBI selling dollars to prevent the currency falling. The rupee has depreciated sharply against the US dollar and is trading at close to record lows. RBI has stepped in to sell US dollars to manage the stability of the currency so that it doesn't go on a free fall. And because of this selling, the liquidity has come down, gone into deep deficit in the system. So when RBI sells dollars, they absorb the liquidity, rupee liquidity from the system to provide dollars to the market. Now, coming to the why this rupee is depreciating is clearly be due to the global market volatility. The government is now driving volatility across the globe in terms of tariff wars, and that is impacting sentiments globally. And foreign investors are pulling out of Indian markets. Equity markets are down sharply. Bonds too are seeing muted or even negative flows into Indian rupee bonds. And all this is impacting global sentiments and volatility. And the central banks and policymakers are trying to step in to manage this kind of volatility. So RBI in its February policy had cut rates by 25 basis points and are likely to cut rates again in April to prevent the damage on the economy from a lot of other factors. What has RBI done to address this kind of liquidity in the system? They have bought government bonds through open market operations, basically open market purchases through auctions. And as of now, they have already done about rupees 1 trillion or 100,000 crores of purchases and are likely to do and have announced another rupees 100,000 crores of purchases this month in government bonds. So this will add close to rupees 2 lakh crores of liquidity into the system. They've already added 1 lakh crores, but another 1 lakh crores will be added. But even after adding 1 lakh crores, the liquidity is still in tight deficit mode. They've also carried out something called a buy-sell swap on the USD INR pair. Now, what this effectively means is RBI is buying dollars from the banks, from the market for dollar 10 billion, which is close to 88,000 crores, and injecting rupee liquidity. So when they buy dollars, they inject liquidity into the rupee liquidity into the system. Whereas when they sell dollars, they absorb rupee liquidity from the system. So now they are, but with the swap, what effectively means is they are buying dollars for today and then carrying out a sale contract 3 years down the line, 36 months forward swap at a certain forward rate. So this enables the bank's systems to RBI to inject liquidity into the system through buying of US dollars from the system. So this they've announced one more. They've already done a $10 billion swap, and that they have announced another $10 billion swap for this month. So together with OMOs and USD INR swaps, RBI would have, if all the swap auctions and swaps are going through smoothly and fully taken up by the system, then RBI would have injected close to 3.6 lakh crores of 3.8 lakhs, 3.7 to 3.8 lakh crores of liquidity into the system. That's a huge amount of injection of liquidity. So clearly, there's a huge amount of tightness in liquidity in the system, and that is forcing the central banks to address this liquidity situation. Now, it remains to be seen if all the surplus liquidity that RBI injected will come out in April and May and make conditions very easy, or it still remains tight due to various other global issues that is still facing the global economy. And that doesn't seem, that volatility doesn't seem to be drying down. Now, on top of it all, there is the credit stress. So clearly, if you look at the results of lenders for the third quarter and guidance for the next 2 quarters, highly muted. Credit costs are going up. That is, the lenders are making more provisions for low bad debts, and loan growth is very slow. So many of them in the microfinance space and the other unsecured space have actually stopped lending or have cut down lending very, very sharply due to worries on credit. Many of them are shoring up liquidity. And all this is putting a huge pressure on the credit risk appetite as well. And NBFCs here are now given tight liquidity conditions, plus global market volatility, plus credit stress. This is all adding to the liquidity worries for many NBFCs who are not very liquid or who are facing a lot of refinancing issues of previously borrowed loans, or definitely not growing their assets, but just to maintain their own levels of liquidity so that they can tide over any kind of short-term liquidity crisis. So all this is pointing out to more stress for NBFCs and others till this liquidity situation eases. So hopefully RBI actions could ease the liquidity situation, definitely not in March, but maybe in April and May going forward. That depends on a whole or other aspects. So all this, and then the government budget had come. Luckily, in one sense, it was a benign budget. They forecast lower borrowing, etc. And all that is pretty positive for government bond markets. With the rate cut looming ahead in April, again, one more positive factor for government bond markets. But having said that, the market will look at inflation levels and other things. Rupee depreciation has impacted inflation to some extent, but that has been negated by fall in global oil prices and other commodities as well, due to worries on global economic growth and recession in many other developed economies. All put together, very unstable financial markets. Volatility will be very high this month, and investors would have to watch out for volatility. Best investments would be risk-free investments would be government bonds. Obviously, they carry price risk, but there's some positive outlook for government bonds given rate cuts and RBI bond purchases and other aspects as well. And going forward, if there is a rate cuts and liquidity is coming back into the system, then higher yielding bonds could also start to gain attraction. But investors would have to be very careful of the kind of higher yielding bonds they invest in. They should be aware of the fundamentals of these issuers. Thank you very much for listening in. Do follow us on all podcast channels, and please do press the button if in all wherever you're listening to, and subscribe to our podcast channel.